Who has a bookkeeper? Who has somebody that is like more than a bookkeeper? Okay. It's not a lot of cash right now, right? So people feel like whatever I'm doing is kind of okay. But at some point, it's going to be a lot more. And the questions around managing this and strategy are going to get a lot more complex. Can you tell us a little bit about why a firm would work with somebody like Propeller instead of doing it themselves or, working with a bookkeeper?
Yeah, sure. I think the most important thing to acknowledge is that you want the right sort of tool for the job at the right time. And for most of the hands that went up that said they had bookkeeping and not a CFO, you got the right tool at the right time. For most companies that are pre-Series A lot of the financial stuff is sort of a nuisance. To be honest, nobody wants to be the company that has incredible financial statements and a terrible product. So stay focused on customers, stay focused on product, and don't run out of money. Don't get yourself in trouble. Get a good bookkeeper instead of a terrible one. But focus on the right things at the right time. Like once you raise a Series A, the rules of the game change a bit. You might have a board, you're going to have some accountability, you've got a whole bunch of other people's money. Your business is hopefully starting to scale in certain repeatable ways, and then you need to step up your game. I think our firm is really built for companies that feel like they need to hire somebody but aren't really ready to do that. So we've spent the last 17 years basically helping companies get from mostly Series A to sort of Series B or C, and then at some point they hire somebody W-2, and we'll sort of start to off-ramp and kind of go focus on the next business.
Cool. And the times that I've most appreciated having that voice in the room, the unintended benefit, I think, is on confidence building. I've seen a lot of board meetings where the founder doesn't necessarily have a business background. They know the product really well, or they know some aspect of the industry really well. They're a security expert or what have you. And then, you have these VCs that come in and go poking around the business. Well, what if we raise a little more? Or what do you really need this salesperson and all this sort of stuff right smack in the middle of the meeting? And the ability to sort of navigate that strategy on the fly, to turn the projections around very quickly, in addition to the 90 other hats that the founder is wearing, is like not the easiest thing in the world to do for them. And the slower that turnaround is, or the more they sort of fumble around in their projections, like it looks work. It's almost embarrassing, to be honest, on behalf of the founder. We have like an otherwise strong founder who, doesn't necessarily have that same support. By the way, it's even worse when the bookkeeper can't do that at a board meeting. And they're just like, hey, I didn't sign up here to be like in a venture capital board meeting. Like I'm just the bookkeeper. And a lot of times they're being asked to do too much in these like strategy sessions as well. So thanks for sponsoring this and being a supporter. I really appreciate it. And thanks for being willing to moderate this panel. So I'm going to jump off, but I'm going to need some able replacements for these seats. And that's going to be Charlotte from Inspired and KJ from GB and Adams from QED. So you can just come on.
I get it right. Thank you, everybody, for being here. What did we call this? Projections and hockey sticks?
Yeah.
That's the thing. So the purpose of this panel is to try to help founders find a balance between sort of the unbridled optimism and bullish possibilities, and then the sort of brutal reality. And especially as it relates to the Series A, which is this phase where the business is starting to find some more focus. How should you be going into the fundraising process with your projections? So why don't we just start with a little bit from each of you about the stage focus and let's do the sector. Why don't you start, use the mic and then.
Does this work?
Yes.
Great. Hey everybody, it's great to meet you. Thank you for having us and thank you for having me. My name is Conrad. I'm with QED Investors. We are a global fintech firm and focused on Series A and Series B primarily, but we're investing in everything from pre-PowerPoint.
Hi, my name is KJ. I work at GB. Clearly I like acronyms. We're a multi-stage fund, and so we cover a lot of ground from seed to somewhat pre-IPO. We're in a capacity of being able to write checks that total up to 150 million. From a sector perspective, we cover a lot of ground as well. So behind the scenes, we kind of split into two organizations: life science practice that covers pharmaceuticals, therapeutics, drug discovery, and then also our digital practice, which is more traditional, so consumer, enterprise, frontier. I specifically focus on early stage consumer and vertical software.
Well, that's
Hi everyone, Charlotte. I'm an investor at Inspired Capital. We are a purely early stage fund, so we just invested seed and Series A. Our check sizes range from 1 million up to 20 million. Really concentrated, so we're only making around 8 to 10 investments a year, and we are generalists. So ranges from healthcare, fintech, consumer, enterprise SaaS, vertical software, frontier.
Why don't you keep the mic for a sec? Let's go back down the line and just say a little bit about how big does a company need to get in order to be investable for you, and then what's your sort of expectation long term?
Yeah, so I mentioned our fund that we're investing out of now is $330 million. Typically at the Series A, we're looking to get around 15 to 20% ownership. And so the way the math works is, over time we expect to be diluted. And so at exit, let's say we own around 10%, you're looking at we kind of have to underwrite every investment to return our fund. So that means that every investment has to have the ability to be about a $3 billion outcome for our fund size and where we'll end up with an ownership at the end. Time horizon, we have 10 to 15 year time horizon. We have luckily, very patient LPs and endowments and pension funds and foundations who realize that things take time, and so definitely kind of no time pressure.
Yeah, I will tackle it in reverse just because there's a bit of context that's helpful. So Google Ventures is a bit of a misnomer in a sense that it almost suggests that we're like a corporate VC of some sort. In reality, we're closer to an NEA or an Andreessen than a traditional corporate VC, but we do consider Alphabet to be an LP. As a result, as you might be familiar with Alphabet in the way that it kind of conducts business, it's a very high profile LP, but one that is also very patient. And so we don't have any strict contingents relative to timeline or anything of that sort. We can be really, really patient capital, particularly across opportunity sets that we're particularly bullish on. And in terms of how big a company needs to be, so the fund that we're currently deploying capital from is close to 3 billion. And the math that was already presented so far would suggest that a multi-billion-dollar outcome is what we're kind of aiming towards in order for us to kind of justify the check, particularly as we kind of come across the market as more concentrated capital. So we're not like a spread and play kind of player, just deploying checks to a lot of different things. We tend to come to things or investments with a fair bit of conviction and looking for category ownership.
Let's see. So we're looking for businesses that will transform how people interact with money. It's going to be big, and it needs to be big. We're investing out of a fund that's just under $1 billion. So similar from a math perspective, I'm looking for billions or tens of billions of dollars in enterprise value. And changing the world takes time. So
Hang on to it for a second. Given what you just said about what you're looking for in exit horizons, and now just thinking about the topic of the panel and projections, it could seem like somewhat of a foolish exercise to look out 10 years and show your business in the Series A as a billion or $3 billion outcome. How should founders think about that? Like, should they even bother? How much effort should they put into that exercise?
Yes. Without looking at any of your financial plans, the only thing I know is that they're wrong. The goal is not to accurately predict the future, though if you can, that's great. Really the goal in building any financial model is to communicate. To communicate with your team, to communicate with your investors, to communicate with potential investors about how you see the future unfolding. The key pieces here are to really unpack and understand what has to go right for your version of the future to unfold. And with that in mind, when I receive a financial model, there's kind of a couple of quick things that I'll do. Kind of first start with a sanity check. Is there anything insane here? The next step is to move into sensitivity, understand the variables that are going to have the biggest impact on your business, and large part, your job as a part of this is to guide my hand there. And then the final step is to look at the inputs that are necessary for you to generate one incremental dollar of revenue. Doing those three things, I at least hope that I've got a pretty good sense of your business and also, more importantly, your vision of the future.
No, I would certainly echo that sentiment. I think, as is the case with likely most of you in here, like This is a collection of very ambitious people that are looking to hard charge into their version of what the future could look like. And with that needs to come some level of ambition and some idea of what the future holds. If you come to me with a model saying this is something that's absolutely 100% certain, I'm going to be a little wary of that. I think what's definitively true is that it's absolutely wrong, and you're likely to throw that out 5 times over. But I would definitely echo the sentiment that it's a conduit with which you can have a conversation. I think the exercise to be done is to give someone a touch point that allows them to understand how your brain works and bake into and basically boil down assumptions from a first principles perspective to understand, like, all right, what do you imagine constitutes success for this business, and how do you plan on getting there? And the conversation around those decisions, those actions, those North Stars is immensely more valuable than the idea of like a hard number for 2026 or 2027. And so to the extent that you can leverage that to have a dialogue, communication around what you think is important and have that be a two-way conversation, I think that's the most important part of that exercise.
Follow-up next question, I guess. There are definitely, in any big group of founders, there's going to be a continuum of sort of comfort zones around how aggressive you should be in your process. And there are for sure some founders in the room who may not have the comfort zone getting super aggressive in terms of predicting billion-dollar outcomes. And that could be a factor of, their safety net. That could be a function of their relationships and networking capacity, or it could just be a function of wanting to really have high confidence in their numbers. Like I'm the kind of person that does what I say I'm going to do, right? And especially, if you've been working with a bookkeeper, you don't have a bunch of financial guidance. Like if you're on that continuum in sort of less comfortable place, what sort of advice would you give a founder like that about building projections for a Series A raise?
Well, I guess after Mike, but I think there's a band that feels reasonable. On one hand, you don't want to sandbag your projection because that's just not as compelling and might suggest that your understanding of where the market might be going is a little bit less than. But at the same time, you don't want to be overly ambitious because that just seems exaggerated and a little ridiculous in some cases. I think investors are likely to see a lot of that, particularly in the climate that we're in. And so there is a sweet spot, if you will, where the numbers kind of tie together in a way that creates something that's exciting to have a conversation around. It's exciting for the investors who may have valuation targets or things that they're excited about when they think about the long-term projection of your business. And exciting for you because ultimately you want to be building something that can fundamentally change market, a category, customer service, whatever the case may be. And so being able to kind of identify what that sweet spot for you looks like is probably the more important piece of it, but recognize that it can be or feel like a moving target.
Sure. How about for you?
Yeah, I would add that I think, as investors, we understand that projections like your model are, we're not going to hold you to those numbers, right? But it does indicate your level of ambition, and that's why it's important. And I'm going to say to all of the women in the room, your projections need to be higher. Doing this for 10 years, I could say that every single female founder, their projections they're just not as high as the male founders. So make those higher because what you don't want is you don't want an investor to look at those projections and be turned off by the fact that you're not able.
You have enough experience at this point to have seen this play out, across different founders. Like, are you making an assessment about the individual, like how the founder is wired when you see their numbers? Like this is a conservative person or this is an aggressive person. Is that really sort of part of the story here?
Absolutely. You kind of don't want to come off as like crazy or just like totally out of touch, but the way you talk about where you're going to be at the end of this year, at the end of next year, indicates kind of how fast you want to move, how big you want to be, and ultimately how successful of a founder you're going to be. And that's like what we're backing, right? Because it's so early that we don't have a lot of this data. And so that level of ambition is a key part in our kind of decision.
How do you look at downside risk or risk protection? I mean, in a business that needs to get to a $3 billion exit, do you care about downside protection? Is that something that founders should even think about going into a projections exercise?
I would say no. This is again, we're investing in Series A. Like we don't need to hear about your plan B and plan C if things don't go well. Those could be conversations we can have once we're in business with you, but at the pitch and when you're talking to investors, like, don't mention that.
Yeah. Adams, what about maybe it's resiliency, like in a business model? Is that something that you can? Same question to you, but trying to get a little deeper.
I think many businesses are not binary. They're very, very early stages where you'll either get off the ground or you won't. But by the time you're at Series A, there's usually a fair amount of off-ramps. And I'm a pretty big believer that there are lots of paths to success, and finding that right balance between being pragmatic, realistic about the reality that there probably are a lot of different outcomes, while also being very clear that the plan is not to sell the first time you get an offer, but about kind of finding the right type of crazy, because turning down what could be and would be a life-changing amount of money is an insane thing to do. Each of you will have to do that, and we're counting on you doing that. So it's a tricky balance to both be very confident and also show that you're pragmatic, understanding of how the world works and how to build businesses.
Everybody likes sort of a disaster story. Do you have any examples of very bad behavior as it relates to projections and financials?
I do pick on anybody, of course, but there's a couple of things that I'd advise you to kind of keep an eye on when you look at your own model. And there's probably kind of a couple different categories here. One bucket is on really important metrics, CAC and gross margin in particular. See lots of models where those magically get better over time. Neither of those things magically get better. Usually CAC goes up, usually gross margin stays flat. If either of those things are not happening, you should have a really good answer of why. And the just cause doesn't work. The other piece to keep an eye on is not all revenues are created equal. Having an appreciation for the different types of revenues that your business might generate and being very forthcoming, very straightforward, very honest about that is very helpful. Given more fintech investors, oftentimes we'll have folks try and convince us that lending revenue is SaaS revenue. It's not. And we're going to find out about it. So you might as well be very straightforward right out of the gate so you don't waste your time. And maybe the last piece I'd flag is kind of what I call drag to the right. I mentioned earlier when I get a financial model, one of the first things I look at is go to the very far right column, wherever you forecasted to, and look at, is this remotely reasonable? As Charlotte mentioned, finding and seeing numbers that are very big, very aspirational, very exciting is great, but also you're not going to generate $1 billion in free cash flow in the next 3 years. Don't let a model say that you will.
I'll try not to repeat what's already been offered, but I'll start by emphasizing, particularly at the earlier stages and across certain categories in particular, I'm not necessarily expecting the founder to have a sophisticated financial acumen to the extent that they can build at the seed or Series A stage, like a 30-tab model with hundreds of assumptions kind of loosely baked in. The expectation that I do have is that you understand your business, your customers, and your market well enough that it informs a very strategic set of assumptions that then fall into what the business can look like. One mistake that I've seen is just not having competency around that, or being very unfamiliar about how these assumptions kind of tie together to kind of like create an opportunity set. And that for me feels like a bit of a red flag simply because it just suggests that that understanding of like market, customer, and so on just isn't quite there. And it's more difficult to my earlier point, to have a conversation around those types of things and really kind of needle into what's really strategically important and what really moves the game.
Danielle and Tony were talking earlier about relationship building sort of before the round, right? Ask for advice, get money, ask for money, get for advice. Do you like to be involved with companies building their models and sort of run up to the A? Is that like an indication of coachability on the founder side? Like, do you ever get involved, or do you like to get involved in that process? Do you like it to be collaborative? Let's start with Charlotte.
Yeah, anecdotally, it's not terribly often that I find myself getting involved into the sausage making of models before there's like an existing relationship that I might have with a founder. And in many cases, a model can be a founder's like precious baby that they kind of like coddle and nurture, do all these things for before it's ready for prime time. I think on some level, there is some signal of collaboration that stems from being able to architect this model collaboratively personally speaking, to kind of want to see it in its presentable form, and then we could take like edits from there. Like I'm not expecting a model to come to me fully 100% baked or perfect or what have you, but with a reasonable enough thought that tells me that this is where your conviction lies. This is like your rough line in the sand, strong opinions weakly held. And that I think catalyzes a more productive conversation than to come to me with like a blank Excel sheet and say like, all right, how should we fabricate this business?
Charlotte, what about you?
Yeah, I would say, I mean, listen, I talk to a lot of founders when they're not raising just to build relationships with them for the future. It is rare for me to kind of get in screen share mode with Excel. It's happened a handful of times, but it's not something that I see a lot. But I mean, I think if there are parts of your model that you have questions about or you're thinking through, you can, that is like a framework for a conversation versus, you know, again, like doing a screen share.
We saw the economics around change quite a bit. We were talking about that at our table just in the last 3 years. Founders optimize for the maximum amount of raisable money, and should they be thinking about that in their models, or should they be optimizing for something else?
Yeah, I think this is something that has come up a number of times recently in the Series A world. I think we're seeing a lot more companies kind of come out and raising, you know, 15 to 20 as their Series A, which is really high. And you would be surprised by the number of times where I'm in investment committee with my partners and we're sitting there and we're like, gosh, like I like this founder, I like this company, I like this idea, but I kind of wish they were raising like 8, you know? And so it's hard feedback to give to a founder to be like, I would be interested in kind of pursuing this path and this dialogue with you if you were raising like half the amount that you're coming out to raise. But that's just to say that like I think that unless you are like the top, you know, 1% of companies, generally like maybe an AI company, a company that has a ton of investor interest, you're better off raising something more conservative, which I would say is in the range of like.
Adams, what about you? If I'm coming to you, 2 different companies, otherwise similar, one's raising 20 on 100, the other's raising 10 on 50. Like, is anything sort of more or less compelling about somebody's ambition based on their model?
Too much into the amount being raised and how it might impact ambition. There's lots of other ways to tell me and us that you're an ambitious founder and have huge aspirations. Raising a $20 million Series A doesn't have to be the way that you communicate that. One way to maybe think about this at Acuity, we think about startups as a series of experiments, and each additional round of capital unlocks a new series of experiments. So if you come to me and say, hey, we're raising a $20 million Series A, well, my first question is going to be, that's a lot of experiments. Why do you need to run all of those at the same time? Or what is unique about the experiment that you would like to run that requires that amount of capital? I think we've all learned kind of on both sides of the table over the past 18 to 24 months that very large pref stacks often lead to tears. And kind of back to my point earlier on having off-ramps, preserving some level of optionality. This is not in my best interest to say this, but if I'm in your seat, I'm thinking a lot about the amount being raised to ensure that I preserve that optionality for myself so that I can make a lot of money in lots of different scenarios. And maybe the last piece that I call out, these are very long-term relationships. And oftentimes, someone that you meet in Series A might lead your B, might lead your C. Chris, one thing you said at the very beginning that really resonates with me is do what you say you're going to do. There's no better way of building confidence and building trust than doing what you say you're going to do. And if you tell me at Series A, I'm raising 20, and then we meet at Series B and you raised 8, I'm already off to a little bit of a weird start. So managing and setting expectations, both as a part of the round itself, through the story arc of your entire company.
I'm just going to add one more thing. Like, I think oftentimes what happens is if you go out to market raising or asking for a smaller amount, the odds of you raising more are much higher, right? Like we had a company recently go out to market to raise a $30 million Series B, and he ended up raising 60. Right? That was an easier move than to go out to the market and be like, I'm raising 60, and then there's just a smaller pool of capital, right? So generally speaking, whatever you go out to raise, you'll probably end up raising more because you'll bring in other people and they'll be pro rata, et cetera, et cetera. So that's also just something to consider.
Charlie, do we have time for another question?
Yeah, we do.
Okay. This is sort of off script, but I'm curious myself. A lot of these founders in this room will do their first serious financial model or raise a Series A. In that sense, it's kind of being done for like an outside purpose rather than an inside purpose. Like they're working with bookkeeping firms and maybe they don't have a full-time CFO yet. They probably shouldn't, right? You raise that money with a fundraising model, and then you got to come in and you've actually got to build an operating model, or you've got to be accountable to a model whose sort of primary purpose was fundraising. You have to see this all the time. The sort of pitch deck hockey stick model, you know, the round closes, there goes, and then you get to your first board meeting, and you know, there's like an elephant in the room. It's like, okay, well, is the model really the model? Do you see that? And how do you prepare for it, right?
Please don't make the first board meeting. There is no need to have the next month, next 3 months, next 6 months projections be unattainable, unreachable. The hockey stick can come a little later and let us down gently.
I think sometimes a productive way of thinking about fundraising, particularly in the context of a Series A, where you're effectively signing on for a relationship that's designed to last for a decade plus, is to start with a foundation of trust and collaboration. And so if you were to surprise someone in the context of a board meeting relative to a fundraise, that might be a really poor way to start off or kick off that relationship. And so I think it may be strategically helpful for there to not be necessarily two models, but you can always kind of like evolve the thinking over time as new information kind of comes in. And I think it's particularly at the Series A, folks are amenable to that. Like they recognize that things change. There's new insights, there's new learnings. The idea is not to change the model every week. That's just not helpful for anyone. But the idea is that it's a collaborative journey, one that has its evolutions and its locksteps. And you're all kind of like pointing to the same type of value inflection point that the model is designed to kind of suggest it to begin with. So yeah, also it's a lot of work. Doing two models, that just seems like a fool's errand. It's a lot of, well, I mean, you can be helpful for that, but
Not good for us either.
We can take two from the audience.
Okay. Questions in the back?
yeah, I don't think we're landing in two different places. In fact, I think what you're articulating is consistent with, I think, the ways in which we feel up here. I don't want to speak for too many people, but ultimately the assumptions that bake into your model then become KPIs through which you govern it. The hard-coded numbers around that are likely to change, but you should have a structure in place that allows you as a founder and then also as a board member and investor to be able to evaluate the business over the stretch of time. And so the alignment is there, and the model kind of like informs and suggests, you know, how those numbers work and tie together. And so it's all part of one overarching dialogue and conversation that you're likely to have.
Any other points of view on that one?
Or any other questions?
For them at their next round. So for example, if you as an investor get access to Series A, then you might want to in a year and a half, they're way far from their.
Be quick and then pass it off. But yes, is the short answer. And like again, like I think there's a fair bit of wiggle room because like this is more of an art than it is a science. I've seen some things that were dramatically off, and that becomes a bit of an amber to red flag for me around the way in which a particular founder or operator is architecting their business or what they see as opportunity ahead of them. It could be just completely misreading something. I don't know what it is yet, and it would be my job as an investor to kind of piece that together, but it certainly signals something worth looking into that doesn't strike immediately as the most positive.
Adam, one of the first things you said was the only certainty is that it's wrong. I think when you have a bunch of experience working with companies going through this, you know it's not going to go down the way that it's, you know, we sort of talked about it going down, right? It feels like there's a lot more sort of qualitative evaluation happening around the quantitative. It's like not just what you throw into the model, it's how you use it and the sort of depth of understanding around it. But like there should be some room for companies to adapt and pivot, I think, to that question, right?
Definitely. You kind of shared earlier, many times someone you meet at Series A is going to lead your B. In the scenarios where this happens to me, the first thing I do is go pull up the whole model. Have one on one side of the screen, the other on the other side of the screen. First and foremost, it is I'm looking to see, has the shape of the model changed? Did you learn something about the business that made you reconstruct how you believe your business works? I mentioned earlier that looking towards the atomic unit of creating one more dollar of revenue. The how you do that might have changed. And naturally, you want to create a different model on that. The next thing is looking at the numbers. And KJ, I think you said it well, of there is wrong and then there's really wrong. There's plotted the two revenue lines on a chart, there'd be a gap, and then I need a different y-axis. If you need a different y-axis, it was too wrong. What I would do if I were in your seat is be very honest about that. Right out of the gate, say, hey, I know we talked today. I'm going to send a model to you. We did not do what we thought we were going to do. Let me tell you why.
Thank you.
All right. Thanks. Thanks, everybody.
So, one housekeeping note that I forgot, and I don't know, I'd be curious to see if this came in. When you all RSVP'd, we asked you a question, or at least on the founder side, what have you learned the most about? And it was pretty open-ended. And the answer to that is what wound up on your lanyard, okay? Does anyone here have a lanyard that says, ask me about myself? Great. We always have a couple, right? So if you were looking at those lanyards and next to that person, you're just like, what is going on? It is because those founders said that they learned a lot about themselves when they answered the question. So this is their area of expertise after doing this. That is what is on the bottom of your list. So that makes a lot of sense. We had one really, really off the beaten path one, and if I remember it, I think I'll have to text Lauren, who used to work with me, on what it was. But it became absolutely hilarious. In table conversation. Okay, so here's what we're gonna do next. We're gonna do another small group breakout until 12:15, and at 12:15 we're going to have lunch. So if your conversation bleeds into lunch, that's okay. But also, please be considerate of everybody, especially investors who might want to eat at that point. So at 12:15, you should feel free to get up to your table. Here's the prompt for this. It's a little wonky. Sometimes I'm a little ambitious about engineering good conversations. We'll see how it goes. But I've asked the investors to share a recent deal that they just did or considered. And they are going to effectively pitch it to you guys as the investment committee, because I want founders to get in the mindset of, I'm going to pitch and the investment committee is going to ask a bunch of questions at me. And sometimes it's tough to sort of get out of the weeds and get out of the drinking the Kool-Aid and all this sort of stuff. So I want you to ask the question of, yeah, if I were sitting there hearing about that company, here's how I would ask. This is what I think the risk would be. How did your firm get over that? And the investors are going to share. So you don't have to say exactly what the company is. This is the point at which we realize whether or not the investors actually read the schedule and the notes we had for those ones. So some of them will probably be better prepared. I have a feeling Adams probably wrote it because he had a whole long list of notes that he took with them to the last panel. So they'll be sharing their last companies, and you as a founder should ask due diligence questions and find out how those companies answered that. All right, and we'll do that until 2:15, and then I'll announce that lunch is on the table. 12:15. 12:15. Okay.